SoFi was classified as a meme stock that should have never been a meme in the first place. In fact, it's as legitimate as they come, and in this video, I'm going to prove that to you as we await the neobank's earnings to be released. Welcome to Own the Chaos. My name is Brad, and I'm here to take you on a wild ride through SoFi stock's Q4 earnings results that are set to drop tomorrow. Now, I know what you're thinking. SoFi's earnings reports can be about as thrilling as watching paint dry, but trust me on this because this one is a little bit different. With a consensus earnings per share estimate of a loss of 7 cents and a revenue estimate of $425.53 million, the market is expecting a solid quarter. But will it be enough to make the student loan refinancing business that's been under a ton of pressure due to the moratorium jump for joy? There is so much about this company that few realize, and I have 7 areas that I myself am paying attention to, and I think you might want to as well. The first one here is that CEO of SoFi, Anthony Noto, set a pretty low bar last quarter by saying that they're targeting 400K new members each quarter. But as we all know, the last 4 quarters have all hit above that number. So let's aim higher, shall we? After all, Q4 is historically a strong quarter for member growth, especially with the added exposure from the brand new SoFi Stadium during the NFL season. Now, I have to admit, last quarter was a bit of a surprise as it was the first time since 2019 that SoFi saw less than 10% quarter-over-quarter member growth. But let's not forget, relative growth will slow down eventually. It does for every company. However, I believe that the combination of the stadium exposure and the best-in-class APY on their checking and savings accounts, which is 2.5% and 3.75% respectively at the time of this recording, will give SoFi the push that they need to exceed that 10% quarter-over-quarter growth and add over 500,000 members in this quarter. You heard it here first. SoFi's success lies in their ability to not only bring in new members, but to increase the value of each member by getting them to sign up for additional products. By doing this, they increase revenue, build stickier relationships with their members, and incur no new customer acquisition costs. This cross-selling strategy has been a smooth sail until lately when it hit a rough patch in the past 2 quarters. This is where the introduction of SoFi Plus comes in as a ray of hope. SoFi Plus rewards members who deposit $1,000 or more per month with a range of perks crossing different products. Fingers are crossed that this boosts in member engagement and will result in more product signups and push their products per member ratio above the last quarter's 1.52. After all, everybody loves a good deal. The big question on everyone's mind, though, is SoFi's customer acquisition costs, or CAC, on the rise? While it's difficult to determine exactly how much they're spending in customer acquisition, the trend does seem to suggest an increase. However, management has stated that they're satisfied with the current CAC, and I believe that the lifetime value, or LTV, of their members justifies the marketing spend. As a numbers person, I'll be keeping an eye on this during the earnings call to see if there's any key insight to the company's marketing strategy and efficiency. Will we see improved margins in the financial services segment, or is SoFi happy with their current CAC? Only time's going to tell here, but it's definitely something worth keeping an eye on. Next, SoFi has been growing in its deposits steadily since they received its bank charter, with a strong emphasis on direct deposit members who account for 85% of all new deposits. This deposit growth is important as every $100 in the new deposits generates around $1.25 to $1.50 in yearly annual revenue for the company. Here's why that deposit growth is so important. Every $100 in the new deposits generates around $1.25 to $1.50 in yearly revenue for the company until they are able to fund their entire loan book with deposits rather than relying on warehouse lines of credit. This can translate to extra lending revenue, which is a significant revenue stream for the company. The deposit growth trend has been linear so far. It is expected to continue or even accelerate, as seen in other digital banks like Discover and Ally, which are offering lower APY on their savings accounts compared to SoFi. Lending Club's deposit growth is not expected to be as strong, but their earnings will be worth keeping an eye on as well. My next point here is that this quarter is expected to be the one where SoFi surpasses Lending Club and personal loan originations. SoFi has already blown the doors off of Upstart. Hey, Mark, you know what Upstart does, right?
What does Upstart do?
Well, I'm sorry.
What kind of company is it?
Yeah, I'm not. You're breaking up.
Anyway, Q3 of 2022 is expected to show growth in its personal loan originations, which should be above $3 billion for the first time. The demand for this product remains strong, and SoFi's liquidity is high enough to meet the demand. On the other hand, Lending Club has recently announced a layoff of 14% of its workforce, and its total originations have decreased by 30% quarter over quarter to just 2.5 billion, mostly due to a combination of weakness in the marketplace, originations, and a tightening of crediting standards. However, despite the uncertain economy in 23, SoFi is expected to continue increasing its originations without compromising its lending standards, and that should speak volumes to any investor. Then there's SoFi's tangible book value, as it has been increasing, which means that the loans in their loan book are not losing value over time and that they are generating positive cash flow, despite the fact that free cash flow is not an ideal metric for banks. SoFi's actual cash flow was 18 million in the third quarter of 22. A recent analysis by JP Morgan analyst Reginald Smith highlights the risk that SoFi could be caught in a vortex of a once-in-a-generation Fed tightening cycle. This tightening cycle could lead to write-downs in their loan book as demand from capital markets dries up and amount that they can charge for their loans decreases, thus decreasing the fair value of their assets. To track this, though, investors should look at book value, which will reflect changes in the value of their loans. In the third quarter of 22, SoFi's tangible book value increased due to their positive cash flow, and it is important to look for this trend to continue in the future. If that wasn't enough, here's two more things that I'd like to add that have been at the top of everyone's mind over the last 2 years. The first is loan sales. SoFi's strategy to extend their holding periods from 3 to 4 months to 6 to 7 months is expected to keep their loan book growing, but with a slight risk. The decrease in demand from capital markets can affect more than just the fair value of their loan book. SoFi's ability to expand their loan portfolio is limited by their available capital, and selling loans for a profit has been a key part of their business for over a decade. They have a history of maintaining a gain on sales margin of about 4 to 5% for their student loan and personal loan portfolios. However, this margin has been gradually decreasing, and any further decline in demand will impact it first. Investors really should keep an eye on this, on the volume and loans sold and the profits generated from these sales as well. And then, of course, the big elephant in the room is the student loans. There are concerns that SoFi might actually miss estimates this quarter due to their guidance, including a small increase in student loan originations in Q4. This was expected due to the moratorium set to expire at the end of December. However, as it has always happened since this moratorium took place, a similar boost in originations occurred in Q4 when the moratorium was scheduled to end on January 31st of 2022. But once again, it was extended when student loan forgiveness was postponed until the Supreme Court heard the case. This extension came after SoFi provided their Q4 guidance, leading some to worry that the loss of these originations will negatively impact the quarter's earnings. As always, I try to present the good with the bad, and this is certainly something to watch out for and have some concern over. SoFi's upcoming earnings report is going to be an important one to watch, given the expected growth in personal loan originations and the stability of tangible book value. So what can we take from all of this? SoFi's upcoming earnings report is going to be an important one to watch, given the expected growth in personal loan originations and the stability in tangible book value. While the macro environment remains uncertain, as we all know, the Fed, the recession, all that stuff that's flying around, they have a strong liquidity position, decreasing loan sales margins, and potential missed estimates on student loan originations are some of the key areas to look out for in this earnings report. Be sure to tune into my live stream on Monday afternoon and to react to SoFi's earnings and get my reaction to other earnings as well at 3:45 p.m. Eastern time. Until then, guys, stay safe, enjoy the rest of your weekend, and see you Monday, fam. Bye.